Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our webinar on understanding and trading the economics calendar. Now, for those of you that are joining us for the first time, ETX is a regulated provider, and I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to risk, and seek advice if you do not understand those risks. All information that's provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned are for educational purposes only. And for those that are joining us through the internet and don't know much about us, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we are also a member firm of the London Stock Exchange. Now, when you trade with ETX, you have many choices. If you're not sure what they are, our customer support will help you explain everything and set you up wherever you need to be. But you can trade ETX binary. And that's a good place if you're starting out or you want to test a strategy. You can then use our ETX Trader Pro to trade CFDs or spread betting if you're in the UK. And you can trade commodities, currencies, stocks, and indices with some of the lowest spreads in the marketplace. And for those of you who want a more professional platform, you can download our ETX MT4 platform where you can add on expert advisors, you can use our advanced charts, and you can even use it to automate some of your trading systems. And again, if you need any help making your decisions or want to have several of these, just contact our customer support department and they'll be glad to get you what you need anytime you need it. Now tonight we're going to be talking about the economics calendar. And the economics calendar is a fundamental analysis tool for traders to position themselves to take advantage of future currency moves or any asset. The economics calendar, which is published daily, is the main trading tool for traders that use fundamental analysis as signals for entering and exiting trades. Now, if you're not sure what fundamental analysis is, we have lots of classes. We have our class called Trading from the Fundamentals. We also have a class called Learning Technical Analysis, an Introduction to Technical Analysis. Coming August, we have a whole bunch of new classes launching for you. One class just on Bollinger Bands, one class on MACD, another class is Mastering Trend Trading. So we have a whole new semester coming out for you coming in August for the August, September, October semester. So watch for the postings on your website, on the ETX website. Now, economic and political news can change the direction of a currency pair and asset in seconds. And fresh fundamentals that happen one moment can be completely changed or reversed, or the price movement can reverse the next moment. The economics calendar enables traders to keep track of economic indicators and political events. Now, most traders, or most especially new traders, don't even realize that there is a standardized economics calendar. That means all these economic events are standardized. They are rated. They come in three-tier indicators of how important they are to the financial markets. Now, what you have to understand is these economic reports were not developed for a Forex or commodities trader. They were not developed for CFDs or stock market trading. These are the important economic and statistical reports released by governmental agencies or other major reporting agencies like the Institute of Supply Management, Thomson Reuters, but they are all about the economics of a country. And it might be that something isn't important to you, or if something's not important to the Forex market, but it could be vitally important to somebody looking for a job in healthcare. Or if you're a healthcare recruiter, the jobs market report, the non-farm payroll report, isn't crucially important, only that little paragraph under healthcare workers. But if you're a healthcare worker and you only have a business in West Virginia, that little tiny section on West Virginia only. Or if you're a specialist in geriatrics, you're more concerned with how many seniors are being hired or laid off. Okay. but none of that has anything to do with the financial markets because, again, these reports were not developed for the financial markets. But over time, this calendar was developed and this rating system was developed for these events that affect the financial markets. Now, the, the name of the report you see on the line is what we call the headline. It's the important part of the report that affects the financial markets. So when we're looking at the big important non-farm payroll reports, the number of new jobs, the unemployment rate, not how many people under the age of 20 were hired and how many college students got laid off. But all of that is in a report. These reports are statistical reports that are huge. So when you start to think that this huge report is put together relatively close to the end of the previous month, that a lot of times all the data hasn't come in. So then you have the next month revisions because all the data comes in from all the corners of every country. Now the other thing is just about every country in the world has the same data, has the same events. You know, New Zealand has a central bank, Eurozone has a central bank, the UK's got a central. They're all having their meetings, they're all releasing their interest rate reports, they're all making statements, they're all deciding on quantitative easing or stimulus. They're all doing basically the same at different times and at different formats. But it's important. Or like the US jobs report is called the non-farms payroll report. In London, the jobs report is called the claimant count. In Australia, it's just called the jobs report. And after a while, you get to know these. But once you get to know the names, let's learn how to read this calendar. And I'm going to take you over to a live calendar. But you have to remember also that there are a lot of events. And all of these events are scheduled way far in advance. Like we're looking here on the top line here, Chinese industrial production. That report is released virtually the same day, every month, month in and month out. So we already know when it's coming out. And that's the nice thing about the calendar because we can prepare ahead of time for these events. So let me pop up a live calendar for us. It'll be on the screen in a second. And we're going to take a look at some events that haven't happened yet that are due to happen this week. And we're going to just look at tomorrow. And I'm going to click across the box up here that says tomorrow. Now, we can forget all this stuff from investing.com. Okay, and I'm going to get rid of it. Let's see. I'm going to open up the filter box because, you see, you can filter all these events because if you left on all the countries, all the events and everything else, you would be inundated with data. So hopefully, yeah. So now we got rid of that report so it's not messing up my screen. That's the only reason we got rid of it. So now we can see the first thing you have to do when you're using the economics calendar, it's very, very important, is you have to locate the time button so that you can set the calendar in your time zone. Because you don't care that this data is being released at 8:30 a.m. UK time if you're living in Australia. You only care what time it's being released in your Australian time because you don't want to make a mistake, calculate the time wrong and miss the event. So every calendar, no matter which you use, has a time setting feature. Now, some of them automatically adjust to the time in the IP address in which you're logging in from. So sometimes it's already set for you. Now, a little thing I have to explain a bit. Okay, all of this data comes into the calendars by feeds directly from the releasing agencies. Now, these feeds come in a standardized format. So even though a calendar might look slightly different, that is simply the graphic designer's design and creativity on their particular website. And they have some latitude as far as scrambling the stuff from the feeds. So like here at investing.com, we can see right here when they're rating the importance of the data, they use bullheads. It's still a 3-level system. So all they've done is hold their system. When a number 1 comes in this column, put down 1 bullhead. When number 2 comes in this column, put 2 bullheads. But it's still 1, 2, and 3. So there's some flexibility, but otherwise, and I'm going to say this because I can't guarantee you 100%, because there's some odd ducks out there, but 90% or 95% of accounts are all identical. They're all getting their data feeds from the same place. They all show the same thing. It's just how they display it. Now, for instance, here, and almost all are in the same order, we have the time. This is the time of the event. Then we have the country and the currency of the event. Okay. Now, some are slightly different here. Some will just have a flag. Some will have the name. Some will have, but again, it's just how they tell their system to, if it says New Zealand, put it in NZD. If it says Japan, put it in JPY or just put a J, or just put a yen symbol there. Okay. But again, it's only in the creativity of the graphic designer and a little bit in the development, because they all come from data feeds through APIs. Then we go to the next column. This is a confusing one, only because all the economics data is broken into 3 levels. Tier 1 being the lowest level. It's important data to be aware of, but it doesn't move the financial markets. Level 2 data is very important data and could have some effect on a particular part of the financial markets. Like if construction reports came out very strong, it's not going to affect the dollar or it's not going to affect the euro, but it might affect some of the stocks. If you're trading, a stock that's in the building, it might have a little bit of boost for that. Okay. But it's not going to shift the currency. Then level 3 data is crucial data and will have a big effect on the markets. And a lot of times, level 2 data is subsets of a very important report. So like when you see here on this example, and this is a live counter for tomorrow, is we have Chinese CPI, that's inflation, consumer price index. This number is the important number. Okay, but we also have month over month consumer data, and then we have PPI, which is producer's price index, which is basically wholesale price or producer price inflation. Okay, so this is the important number of this report, but these two are still important, but they're subsets of the original report. Now, nobody expects you as a beginning trader or a beginning guy who's using the economics or somebody who just doesn't use it often to understand and know what all of this stuff is here. Now, regardless of what calendar you're using, they will also have, some will have a hyperlink, some will have a little box, some will have an underline, some will have a little asterisk, but they will open up a window that gives you some crucially important data. First of all, they're going to explain to you what the report is. So if you didn't know what the CPI report was, it's going to tell you it's a consumer price index. It's going to tell you what it does, why it's important. It's also going to give you the source of who's releasing the data. Now, when you have time, you should go and click on one of these and actually look at a full data report. Once you've looked at one, you'll never go back and look at it again. I mean, it's hundreds of pages of statistics and numbers that you can get lost in that have no meaning to you. Now, it also will give us some charts. These charts we're going to find important later when we have to decide how we might trade or how to understand what this number is coming out of the calendar. Now, here's where you have some variation because the charts don't come by data feeds. The charts and the data inside here all come from the provider, the website you're looking at. So it's like you're looking at FX Street. They have incredible charts that go on that detail everything on each economic event. They've done a marvelous job inside. Investing.com hooks theirs directly to these charts and then all the recent news about that particular event. So there's all different features from different calendars. But let's go back to this event. Now, we've seen that this report will be released at 1:30 in the morning GMT time. We know it's out of China. And what you don't know is what assets this might affect. Well, since China is the major trading partner of New Zealand and Australia, the biggest effect a data report out of China will be on the Australian dollar and the Canadian dollar. It will also affect, because most people don't trade the yuan. It's not that much in liquid. It's not that liquid, and very few people trade the stock exchange out of Shanghai. So the assets that will be affected are the Australian dollar and the New Zealand dollar, which have the biggest effect. But the nice thing about these is you know what this event is way ahead of time. You can do your research. You can do your prep work. Okay. And that's the thing about economic events. It gives you the time to do your research. It's a slower way of trading and preparing. It's not like doing technical analysis where you're using up to the minute and that number changes all the time. You've got all week to research all of this. Now, let's jump over to the far right of the calendar. We have 3 columns over here. The last is called previous. We're starting all the way over here at the end. Okay. And again, sometimes you'll see a calendar that shifts them around. Sometimes you see a calendar that actually changes the name from previous to prior, or whatever they want to use. Doesn't make a difference. The number in the previous is the number that was released the last time this report came out. So the last time this report came out on Chinese inflation, it was 1.5%. Plain and simple. So last month, on about June the 10th, when they released this report, we could fill in the previous. Now, that previous is important to know. Now, the other thing you have to keep in mind is the economics calendar is not an analytics tool. It doesn't do any analysis for you. It's not evaluating anything. It's releasing straight numeric data, which is very, very crucial because this allows you to make your own determinations without having to filter out what the website did to that data. Now, from there we go to about a week ahead of time, we get the forecast, or sometimes called the consensus. This is a place you might see some slight deviation from website to website because the releasing agencies do not release a forecast. The government doesn't care about you trading in the financial market, so they're not going to release a week before what they think the non-farms payroll report is going to be. That's not their job. But every once in a while, you'll see, there's always forecasts, and you'll see if you're reading Bloomberg, that Bloomberg's analysts, called 26 economics people throughout the country, and this is what the consensus was, or this is what their forecast. Or Thomson Reuters will say our in-house analysis of our economic staff expect this report or forecast this report to come out at this number. It's only a forecast. It's only an expectation. It's important though, and you'll see very little deviation from one to the next. Now, sometimes reports like the non-farms payroll report, if you're forecasting, they're expecting, one may be expecting 184,000 jobs, one may say 182.5, one may say 188, but it doesn't make that big of a difference when you're talking about 180,000 jobs. Or in the U.S., housing market, they may say they expect the annual sales to be 5,549,000, and somebody else may say 5,448,000. It's a small percentage because it's the actual that we wait for. Now let's go back to my PowerPoint for a minute. Let me pop that up on the screen because now I got to explain some stuff to you. Now, I'm going to tell you a story about your kids and their report cards. Because you got to remember, economic events are like the report cards on your country's economy or a company's economy. Just like a earnings report from a from a publicly traded stock, it's just like their report card. Now, you sit down to Sunday dinner with your kids and you say to your son, well, kiddo, report cards are due Wednesday. He says, yep, I know, Mom and Dad. And they said, well, how did you do, son? Or how do you think you're going to do? Well, your son's a pretty good kid. He's level-headed. He's a good guy. You trust him. He gives you straight-up answers. He's not, he's not a problem. So, you take his word on, take it, on his word. So he says, well, if you remember right, Mom and Dad, last semester I brought you home 4 C's and 4 C pluses. They said, that's right. We remember. Well, what was that? That was the previous. Now, he says, I think this semester I did a little bit better. I think I'm going to bring you home all C pluses or maybe 6 C pluses and 2 C's. Okay. Now, you're good parents. But you're not going to do any analytics data. You're not going to the school and talking to his teachers. You're not calling the principal, finding out if they changed grading systems. You're not going around talking to the other parents and taking statistical measures of how their kids did. You're not finding out about how the grading curve might have been changed this year. You're not even sure whether it's harder in 8th grade, grading harder in 8th grade than they graded in the 7th grade. You're not doing any analytics data. You're taking this on the straight numbers that are being released. So you say to your son at dinner, well, kiddo, you know what? You need to cut out some of that football. You need to cut back a little bit of that FaceTime, and you need to get better grades. You're getting ready for college in a couple of years, and if you don't get your grades up, you're not going to get scholarships, and you're not going to get accepted in the university you want to go to. But that's as far as you go. Again, you're not doing any analysis. Okay? You listen to his forecast. There was some news, some headlines. And then come Wednesday, he brings in his report card. And he hands you the report card and runs out the back door. You open up the envelope, and what is it? He's got 8 B's. You're thrilled to death. You're ecstatic. Again, you're not calling the school to find out. Maybe they pushed everybody's grades up because they wanted to get some money, grant money from the city, or the new principal changed the way the teachers grade. Again, you don't know. You're just opening up the report card, taking it on that number. Now, you're so ecstatic, you holler out the back door, say, you know what, kid, we're going to go to the mall. You can buy that new soccer ball you want, and then we're going to go out to dinner wherever you want to go. He says, thanks, Mom and Dad. You get on the phone right away, start calling his grandparents, tell them how good he did, because you're happy, you're thrilled. Now, this is what happens in the markets, because the markets set their heart based on the expectation or the forecast. And prices adjust to that expectation or forecast ahead of the event. When that event comes out worse than expected, it has a very negative effect. Not worse than it was last month, but worse than it was expected. When that event comes out better than expected, it has a very positive event, reaction on the market. on the currency or the stock or the asset gold being traded. But if it comes out pretty close to the consensus number, not what it was last month, if that consensus was much better than it was last month and it comes out at that consensus, you have very little reaction. But what you have to remember is in the financial markets, things happen very quickly. Because what happens is all of a sudden you're getting everything ready. You put dinner back in the refrigerator because you're going to go out. And while you're doing that, the soccer ball comes in the back window, smashes the glass, hits your favorite vase on the table, breaks the vase, and now you're pissed. Number one, there's no more dinner, no more soccer ball, because now you got to board up the window, call the handyman, clean up the glass, and you're mad at the kid because you've told him 100 times not to play soccer on that side of the house. So what's happened is another event offset that event that would happen. Now, after that event, the contrary event happened. No, everything's quieted down. Everything's cleaned up. Everybody's had dinner. You called the handyman. He's coming in the morning to fix the glass. And kids are gone off to bed. You sit down with your husband and you're having a drink. And you say, well, you know, that kid's report card was pretty good. And you start being happy again because all the stuff is cleared out and you've now got a new goal. You're now a little bit ecstatic. You're not as ecstatic as you are, but you seek a new level because now you're expecting to stay at his B level. And you're happy. So in the morning, you're not mad at the kid anymore. And you're going to tell him he did a good job. And again, this is what happens in the markets. Okay, that asset may get very volatile and have a knee-jerk reaction. Then there could be some other things, but then it'll seek its own new level based on that economic event. Okay. So there are several different ways or different trading strategies that you can employ. Okay. Because you can take the short-term method to trade the volatility. You can take the method to trade the asset before the event while the markets are seeking its new level based on the forecast, or you can wait till the markets have settled down and then find that new level and trade that asset reaching that new level or where its new pricing will be. But that is your trading style. The difficult time, or the thing that we have to do, is learn to build what we call a matrix of market neutral, market positive, and market negative. And this gets a little bit complicated. It's not as straightforward as it seems. But the nice thing is it can be done way ahead of time. Because what you should do is a couple days before, like today, you know, if you have a couple hours free, you know, you can sit down, do your research on the events, pull up the economics, look at the major events for the week, do your research and understand what those events are, get everything ready, figure out what assets you're going to trade and what cross assets you're going to trade, which direction you think they're going to go, and have all that plotted out. Then you can start building this matrix ahead of time of market neutral is the area in which that event probably would not show any market reaction. So we're going to use the event on tomorrow's calendar, which we looked at a minute ago. We're going to look at the CPI just because it's tomorrow's event. So let me pop that up on your screen. So first, we're going to locate the important event out of that event package. Okay. Now, we can see that that number is expected about at 1.5%. Now, you don't know exactly what that 1.5 represents because you're new at this. So you're going to pop open the click on the line, you're going to pop open the information box. And number one, the first thing we're going to look at is the charts. Okay. We want to get some type of feeling of where this number normally would be. Is this 1.5 an average number? Is it a very low number? Is it a very high number? Where does it come out? Well, if we take a look at the 1.5, which is the expectation tomorrow, we can see that inflation's been above it and way below it. But this 1.5 actually looks about what the average is. So that helps us a little bit. Now we have some type of understanding of what this is, because some events come out in big numbers or some come out in little percent. But do you know that the average is only 0.2%, or is that just a very low number because the economy is very bad or inflation is very low? So you have to have some type of information to start making your judgments. So we're going to say 1.5 is middle of the range event. Okay, it's the average of what the event is. So if it's a little bit higher, a little bit lower, we're probably not going to get much market reaction. But see here where we had inflation all the way up, and inflation all the way up here at 2.5 is a very bad thing. And if we were expecting 2.5 and it came out a slightly bit higher, that would have been a really bad thing because it was really way too high and it's still climbing. 1.5 is the very middle of the road. So we know that a drop above or a drop below isn't going to be a disaster. But this is only because we have to have a knowledge base. So then we're going to go look at the last 6 months of data releases here because we want to see a couple things. What's the average? What is the deviation? Does it come out at forecast or does it always miss forecast? Okay. Well, there's a lot of times where things miss forecast only because it's an odd time of the year or it's an odd month and the month broke in the middle of a month, middle of a week, and sometimes you have odd data. But we can see like last month, this number came out right at expectation. We can see the previous month, it was a wee 1 point higher. Here it was 1 point lower. Here it was a very bad month for some reason. And here it came out 1 point higher. So we can see the variance is only 0.1%. So that's a very, very tight range because we're trying to build this market neutral. So we have to say, and so our hands are tied because 1.5 is the average and it only deviates or misses by 0.1%. So we say this report comes out at 1.4 or 1.6. This gap, we could say, is market neutral. But that's a pretty wide gap for something that's coming out at 0.1%. And the fact is there is no other decimal point we can go over because it doesn't report that far over. So we kind of have to say market neutral is going to be at 1.5. Not a little above and not a little below. And if it misses and comes in a little bit lower, it's probably going to be a little bit weaker than inflation, but that's going to be a good number. If it comes in 1.6, that's going to be a little bit bad number because that's going to show inflation still climbing in China and getting up. When we start getting near that 2% level, it gets kind of scary. So we've seen a steady growth for the last few months and a big upward jump, and we don't want that inflation to keep jumping up. So we're going to set a very, very tight range. But now we have to do some things that leave us some leeway because we haven't talked about two different things yet. Okay, so let's go back to the calendar. And I'm sorry, the system doesn't allow me to take off a couple lines. It either wiped the screen clean or not. So I can't kind of wipe all this out. Now, we haven't talked about the previous in any great detail. The previous, like I said, is what this report was the prior time that it was released. But because there's so much data and the data is constantly being analyzed that the next month after the report's being released, there can be a revision. Because when they get all that data in and they finally do their final statistics while they're closing out the month, if it's higher or lower than what was reported, they will release a revision to that report when this report is released. So, and that has to be taken into account for the market reaction to this report. Now, the thing about this one is, so anytime you see a green or a red number in that previous column, green tells you it was a positive revision, red tells you it was a negative revision, and you can always put your cursor on the actual number there, and it will tell you what it was and what it was revised to, but only after it's released. You can't do this before because it only happens to release. So we can see there's nothing over here at the moment. Now, the other thing we have to be ready to take into account are the other sub-reports. But because you can't statistically analyze all of this data, because they're not separate reports, you have to put it into this. So you have three things you have to look at in this case. It's the revisions, it's your CPI month over month for the month of June, M over M, and then we have PPI. So we take these as bumps. Okay. And that's all you can take it, because we see we've now said anything in a 1.5 range is going to be market neutral. Anything pushed to 1.4 is market positive in this case, and in this case anything higher than 1.6 is market negative. Okay. Why? Because climbing inflation, normally in most cases higher numbers are good numbers. In the case of inflation, higher inflation isn't a good number, except like for the Eurozone is it down at 0.0 or 0.1. They're going to try to be getting an upward trajectory close to moving to no higher than 2%. So 2% is the key level. But if you see inflation climbing and is climbing, getting out of control higher and higher, you can't wait till inflation hits 2.0 to react, because once the wheels on the locomotive are moving, it takes a long time to stop it. So with Chinese inflation, we're getting up to that 2% and it's rising. So we don't want to see it jumping higher than that. We don't want to see it. Now, we don't mind seeing a slow climb. But if we start seeing it pushing up too fast and too high, they're going to have some type of reaction from the central bank, because they can't let it get out of hand, because that means the price of domestic goods are going to get too high for the consumer. Now, when we get this report, we're going to first get the CPI and the PPI. If they're at expectation, there's nothing you have to do. If they're slightly better, all this can do is we're going to set our barometer. So this is like say a thermometer, and we've got the thermometer on 1.5. Okay. If one of these are better than expected or worse than expected, we're going to have to bump that thermometer a little bit, a part of a degree. So if we were to get, say, one better and one worse, we'd end up back where we started. But if you got two worse, okay, we'd end up with two bumps down. So you'd have a bump down here and then a bump down to here. And then if you got a revision that was a negative revision, you could get a bump down here. Because this is going to tell you where the market will react to that currency, where the currency markets will react to that report. So there's no finite number. Okay. The important number is that headline report. It's going to be the overall controlling factor. But let's give you a hypothetical. A year ago in January, our non-farm payroll report was shockingly low at 139,000 jobs. The market went crazy. But then an hour later, everything went back to normal because everybody was saying you're crazy. Because if you look at the quarter, we had 139,000, but we had 250 last month, 200 the month before. So if you average it out for the whole quarter, it was a great quarter. Or you had a great jobs number and unemployment also fell. Unemployment can only be a bump. But if unemployment fell and the jobs number was great, it was magnified how good that jobs number was. Or like this past month, we had an exceptionally good NFP, jobs report, and last month was a terrible jobs report, but we had a revision upward to last month by about, I think, 25,000 jobs. So we can't go back to last month and say, oh, that was really good, the dollar's going to change. But it magnified the response this month because it also took the quarterly average and pushed it way up. So we have to take this into account. So it's a matter of, and because these trade in small amounts, it's focusing on how much this is. And this is why you have to start, and this is why the economics calendar is such a great tool, because you wouldn't know a lot of the stuff I'm telling you. You don't know how inflation is going to affect the central bank, what the government's reaction is going to be, without doing some research, okay, without having some time to look at this. But if you were to look at it on Sunday for an event, well, this event's coming out tomorrow morning, but say if you had a chance to look at it Friday and over the weekend, you did all your research, you read a couple articles that explained to you and told you exactly what we're expecting and what the expectation, you could then have a fairly good understanding of this. And then all you do is you lay this on a spreadsheet and you lay out the assets you're considering trading. Okay. In this case, we talked about, we would look at the Australian dollar, New Zealand dollar. We'd look at the Australian dollar against the US dollar and the New Zealand dollar against the US dollar. Okay. Because those are the ones that have the biggest effect on Chinese data. Now, if you had time to read all these reports ahead of time, you'd find that in this case, most Chinese data affects that way, except the import-export data. We dig into crude oil and want to see where their imports of their crude oil were, because that could have an effect on crude oil prices also. So once you've determined what assets you would want to be looking at, then you would build your trading matrix. And you say, okay, if the final is in market neutral, I would trade the Australian dollar to go down. If then the final number is in market positive, I would trade the Australian dollar to go up. If it's in this range, I don't have a trading opportunity. Okay? You've got it all laid out ahead of time. Decide what you want to trade, how much you're willing to trade, because you're not really concerned with where the price of the Australian dollar is. You're concerned with the momentum and the volatility that will erupt at this point. Okay. And then you have to figure out what your strategy will be. There's some people, like myself, I wait for a few minutes after the result. I want the high volatility to get out of the markets because I can't afford the volatile stop losses. So I can't afford that swing. So I want those first crazy people that are going to trade it jumping out, or those people that entered the market before the report who are just selling now or booking their profit. I want that cleared out so then I can say, okay, well, the market is going to still head up from this point forward. But it depends on what strategy you're now going to trade from. But again, you have time to work that out ahead of time. So when you're at the office and a report's due to pop out, all you have to do is watch for that number to pop up on your mobile phone. Look at your spreadsheet with your market neutral, and then go enter the trade based on exactly, because you've already built your trading plan. So decide how many points you're going to put your stop loss, how many points you're going to put your take profit, what asset you're going to trade, what direction you're going to trade, and how much you're willing to risk. So you're ready to make your entry. And eventually you'll get to understand these because all these events are repeated month after month after month. It's an easy way to start trading the markets. Okay. And again, it's one that takes the tension off, gives you time to evaluate, prepare, learn, and understand. And some are more complicated and some are straightforward. No. And you'll find out which ones are crucially important. Like we have PMI, Purchasing Managers Index Report. Okay, this released around the whole world. But you'll know in the UK, construction and services, PMI, which come out in different days, are way more important than manufacturing PMI for the UK. Where in the U.S., it's more manufacturing PMI. And then you'll learn how those relate to jobs report, because the manufacturing sector is way up. That means they're hiring more people from manufacturing, which means jobs are being created. So you'll learn how all of that funnels in together to make the determination of which assets would be affected, why they would be affected, and the longer term effect. Because if you could have used last week's the last month's U.S. manufacturing report and unemployment report to pretty much pinpoint what the non-farm payroll report was going to be. Because once you saw manufacturing PMI so much higher than expected, we created a huge amount of jobs, because that report's a month behind. So they were hiring to be able to handle all of that, or getting all those factories back in full production. So you'll eventually understand how all of this works together and relates together, and be able to make good, solid trading decisions. And like I said, there's many different strategies you can adopt. Okay. And we have classes in all kinds of strategies. But you can use this, like I said, you can use it for short-term trading, which gets very risky and high vol, or you can use a medium term, to figure out where the new level of that asset would be. Let that first few minutes of volatility get out, and then trade that asset to continue on. Okay. And there are all types of ways that you can get into this, but first you have to understand the calendar. And once you understand it and know how to build the matrix, it's just how you apply it to your trading. So thank you very much for joining us tonight. I wish you a very nice rest of your Sunday, and we'll see you in class on Wednesday. Again, thank you for being part of the ETX family, and have a great night tonight. Bye now.